Welcome to MF Corner on CNBC TV18. I'm Vinny Motiwala joining you from our Mumbai studios. 2024 is nearing its close, and as we gear up for 2025, a year that promises to bring its own share of market volatility, in November 2024, equity mutual funds inflows moderated to 35,927 crores from October 41,865 crores. Meanwhile, the thematic fund inflows saw a sharper drop, sliding to 7,658 crores versus a much higher number in the month of October. So what is it that is lying for the investors ahead in the mutual fund industry? What are we watching out for? Which are the themes and sectors that you should be keeping on your radar? And this new year, we are going to be bringing you that as we bring down the curtains on 2024 and raise the curtains for 2025. We'll help you navigate with all these questions. So we're going to be joined by our guest today. We have Harshvardhan Roongta, who's joining in with us from Roongta Securities, as well as we'll have Radhika Gupta also joining in with us from Edelweiss Asset Management, MD and CEO of the company. But Harsh, let me start with you and let's dive right in. Thank you so much, firstly, for joining in with us this afternoon. I just want to talk in terms of overall, what are we seeing in terms of the trend that is there for the market, economic landscape that is there in 2025? How is all that going to be impacting the mutual fund industry? What are we watching out for over there?
So, well, Vinny, as far as investors are concerned, I think investors have had a good experience investing in mutual funds, investing in equities in the last 2 to 3 years. So I believe that they will continue investing. However, investors would need to definitely moderate their returns expectations from equity mutual funds especially, or rather equity investments for that matter. I mean, the kind of returns that you've experienced in the last 2 to 3 years, I don't think the same kind of returns will replicate going further, at least in 2025. Now, specifically because, we'll have to wait for earnings to catch up with the price growth that has already happened. So until and unless we see the earnings pick up, there could be a price correction or a time correction, for a reasonable amount of time. So I guess investors will have to keep that in mind. With regards to debt, of course, asset allocation is going to be important. So I just leave it at that for a moment.
Okay, so yes, that's something that we're watching out for. But, Radhika, good afternoon. Thank you so much for joining in with us as well. Radhika, my question to you is, what are you also anticipating in terms of trends for 2025 for the mutual fund industry? What is the key factor that we're watching out for this time?
So I think it's a year of consolidation for the mutual fund industry. As Harsh very rightly said, as all of us have spoken about, over the last 3-4 years post-COVID, we've seen so many new investors come in to this industry, to equity markets in general, made a lot of money. And this is going to be a year of more muted expectations. In fact, I've been saying for a year that my greatest worry is the almost whacked expectations that equity investors have from their funds. So in a year of perhaps slightly lower returns, and nobody can predict, I think it is consolidation. It's people keeping the faith in SIPs, people keeping those equity investments going, people returning back to the days of normal returns, asset allocation, all those good things that we talk about. And I think consolidation is very important because it brings quality to your growth.
Okay. So consolidation is what we're watching out for in 2025. Radhika, will passive investments like ETF, index funds, will that be something that will continue to gain traction in 2025? What is it that we're watching out on that?
So I think that movement is structural and it's happened in other markets around the world. And if you look at the index fund category, if you look at the number of folios that equity ETFs have, if you look at debt ETFs as a category, all of these have meaningfully expanded. If I look at us as an AMC, 2 years ago, 100% of our flows used to be active. Now 10-15% of our equity flows on a monthly basis are passive. So all of us are steadily seeing an uptake, and this is not just EPFO money, this is retail money. In fact, when I do IIPs and investor events, even in small cities in India, people will pop up and say, oh, what's an ETF? So I think ETF solutions, index fund solutions will grow. I think the color of those solutions will get a lot more sophisticated beyond market by cap based solutions. So one more option in the basket that's here to stay.
One more option in the basket, surely. Harsh, are we expecting a major shift, like she's saying as well, ETFs, that is surely something that everyone has started asking about. But debt markets, let's talk about that as well in 2025. And, we have Trump coming in. We had heard the Fed in terms of the interest rate as well. So, do you think that is something that will pique the interest for the debt markets as well?
So I wouldn't say whether it would peak or not because, we are at a retail inflation of 5.5. And it's way beyond RBI's comfort level of 4%. So I don't see rate cuts immediately, at least in the next 2 quarters for sure. I mean, if it happens in the third quarter or the fourth, I think that'll be good enough. With regards to investors, I think the expectations should be again in the range of about 7.5%. I mean, that's usually the kind of returns that investors will expect. One important thing that I want to highlight over here is, I mean, you might have to play the duration. So if an investor is sophisticated enough or has an advisor who understands the interest rate cycles and could properly time it, I mean, you could play around a little bit during the, around the duration of the fund. So you could possibly go in for a medium to long-term funds in case you're anticipating the interest rates to come down sooner than what I have said. So you could play the medium term or the long term bond funds. So I think that is somewhere that you could try and pitch yourself in case you're looking at additional returns, the extra returns in a debt fund. Yeah. However, my suggestion to debt investors is that don't try and maximize returns, quite honestly. Yeah. Debt is not a product for returns maximization. It's more to do with less volatility, liquidity when you want it, predictability of returns at least. I mean,
so somewhat sort of a safety wise.
Absolutely, absolutely. So don't play the maximization of returns through a debt fund. I mean, that's my suggestion. But Indian investors are very, very very ambitious in all respects. I mean, they want the best of everything with the lowest of cost. So Radhika mentioned about the shift towards index funds and ETFs. Yeah. One primary reason is we want cheap. We want everything jo sasta, jitna sasta.
And we value customers here. We have
also highest return, lowest risk, least cost.
Yeah.
We want all the positives only. That brings pressure on you. Yeah, exactly. We want everything the best, but surely we have to keep in mind all the factors that are there as well. Harsh, what would be the best sort of an allocation that one could have in 2025? Equity, debt, hybrid mutual fund.
So, I have a point here, Vinny, which I've been emphasizing a lot. I mean, when you do an asset allocation, it has nothing to do with the year in which you're starting or how the markets are looking.
Okay.
So, hypothetically, you were supposed to start your asset allocation in 2024. And in hindsight, now we know that markets have done extremely well. The equity markets have done extremely well. Does it mean that a person who was conservative in investing should have gone into equity, the whole hog? No. So what is important is when you're designing an asset allocation plan, for the moment, keep the markets out. Keep the expectation from markets out. What you need to only focus upon is your time horizon, your goals, and your risk profile. So if you have these things in place, then you design a plan. Now, what will change with market conditions, if at all, is the method in which you invest. So if you had lump sum to invest and you're looking at market valuations being at their peak, then you might not put lump sum. Then you might go in for an STP or you'll go through an SIP, right? So the only thing that changes with market conditions is the method with which you will park your money. Okay. But you will not change your allocation purely based on how the market outlook is, because that could be extremely dangerous. I mean, if you require, so I have some people coming to me saying that I need money in 1 year. Tell me which equity mutual fund to invest in. So that cannot work, because in the last 1 year, equity mutual funds on an average given 20%. So I'm looking at 20% in the next 1 year. Yeah. So that cannot work. I mean, it doesn't go like that. On the other hand, we cannot say that we are looking at markets to correct, so let's go and short sell. No, that's not the strategy. So an investor should very, very clearly understand that asset allocation is nothing to do with market conditions. It's to do with your time horizon, your risk profile, and your goals.
On the basis of that, how should I go? If my time horizon is there, my risk profile is there a specific way, no matter what you're starting, if I have to hold it for 3 years, okay, or 5 years, long term, as long as you can go, then what should be the ideal way to actually start investing? Like someone newer wants to start now, has gotten it, then what is the way that you should be looking at?
So what we've done is we've got a table keeping only in time horizon in mind. So as I said, there are 3 factors, right? So there's time horizon, your risk profile, and your goals. However, because risk profile and goals could be subjective to each individual, time horizon can be more or less standard. So what we've done is that we've got a time horizon chart, if I keep only time horizon in mind. So like for example, if an investor wants to be for more than 8 years, so if you're very clear in your mind that you want to stay invested for more than 8 years, you could go 80% equity and 20% to debt and gold. Now, if you're 5 to 8 years, then 60% equity, 30% debt and 10% gold. If you're 3 to 5 years, then 50, 40 and 10. If you're 2 to 3 years, then 30 is equity, 60 debt, 10 gold. If you're less than 1 year, then 90% debt and 10% gold. So nothing comes in equity if you're in 1 year.
Yeah. There is nothing there in equity if it's there in 1 year. Radhika, do you agree to that? One advice that you have to give someone who's maybe starting out now, who's younger, what is the best advice to start in 2025? On the first day of January, what is that one thing they should do today?
Well, if you're young, honestly, the advice is on just to get started. And what I tell people who are salaried, who are often getting started, is look at your post-tax income. It's a very simple formula. Look at your post-tax income and target an investment amount. Now, it could be 10%, it could be 20%, it could be 30%. I think 20-30% is a great place to be. But don't, if I'm saying 30 and you're getting stressed, then start at 10%. And do a basic SIP into one of the equity funds, some multi-cap fund, some balanced advantage fund, one of these, what I call classic dal chawal equity mutual funds. Start an investment there and build up. I think the best message about starting is to start and start simple and do it consistently. And the reason I think SIP works is SIP is a little bit like TDS, right? You don't avoid paying tax because TDS, it's deducted at source. SIP is investment deducted at source. So start. Simple, consistent start.
Just start. That's the word coming in. Whatever it may be, start little, start somewhere. Then you can build on it, I think, going forward. That's a strategy. But I think on that note, we're going to take a very short break. So viewers, don't go anywhere because we will still have Radhika as well as Harshvardhan Roongta who are here to solve all those doubts and tell you all what you all should be doing in 2025 for the mutual fund strategy. Welcome back to Mutual Fund Corner on CNBC TV18. We still have Radhika Gupta, MD and CEO at Edelweiss Asset Management, and Harshvardhan Roongta, CFP at Roongta Securities, with us to talk about mutual fund strategies in 2025. Radhika, let's continue the conversation and talk about sectors, themes. We had seen those thematic funds. Everyone was very enthused about it in 2024. What is the role of that going to be in 2025? Also, international funds, does that start playing an important role now given the whole scenario globally?
So on sector funds, I think I've been asked this question every day of 2024, and I've been a little bit of a broken record, even though I run an AMC, on saying that we went from dal chawal investing to buying too much of pickle and chutney and gulab jamun in our diet. And the fact is that sectoral funds became larger than flexi cap as a category. So my take on sector funds is they remain relevant as satellite funds. And by the way, I have sector funds and I'm still saying this, they remain relevant as sector funds. I think my advice for 2025 with sector funds is a couple of things. One, don't fall for the extremely narrow sector. When you look at sectors in India like financials and tech and consumption, these are broad-based sectors. There are enough stocks for a fund manager to play in this category. When you look at some of the sectors, and I don't want to name them, 3 stocks will make up 80% of the sector. That's a problem. The second is you want to pick sectors that are slightly beaten down. Like we launched a fund in the tech category in March last year when tech was a little out of flavor. Thinking of doing something in the consumption space in January. You don't want to buy into a sector fund when the recent return is 80%, which is unfortunately what people do. So I think the sectors that were the flavor of 2024 may not be the flavor of 2025, and go for broad-based sectors that are out of favor. On international funds, the question's interesting. I think people always try to time international funds and they don't do a fantastic job. I've always believed that for a more evolved investor, 10 to 15% of your portfolio can be international funds. US is a very meaningful market. China still looks like an attractive valuation play. So you can have that combination. The problem is you shouldn't like international funds for past returns. It should be an asset allocation tool.
Dal chawal approach, pickle papad approach. I'm very, very intrigued by that. I've heard this before as well coming from you. But what portion of one's portfolio should be dal chawal, pickle papad? Is it like a real thali that we're eating that
think
division?
It's real thali. I mean, I think it's 80-20, right? I eat 80% of my meals at home and 20% of them outside. And more than that is a little bit of indigestion. Now, whether it's 80-20 or 70-30 is something that you can debate. But it's certainly not 20-80. I mean, I have seen portfolios, Harsh, where people are doing a 30,000 rupee SIP and there are 35 funds, 20 of which are sectoral. That, to me, is too much pickle and chutney. You really want to do things that are all-weather sustainable. And I think in India, where the index is delivering 12 to 15% on large cap and maybe 18% on mid caps, you're pretty good with dal chawal.
Yeah. Harsh, I'm going to come to you. She gave us a portion in terms of how much should be thematic, how much should be, your basic funds that you should be focusing on. I want to understand that, there are a lot of funds coming out on the thematic side, whether it's on sustainability, that's the trend. There's tech-based funds as well, thematic funds. What is it in terms of, would you be looking at that in 2025? Any of that is picking up pace, right? Maybe if they have enough number of shares, or is this as a story of sustainability or technology-based thematic fund a good play to bet?
In all decades, you'll have something changing in the economy. So let's not take away that from investing. Okay, at one point, textile companies were the blue chip companies of now nobody even talks about textile companies. So there is going to be an economic, change in the way the industry and the consumption is going. Our consumers are going to take different products. So obviously, you're going to find areas where there is going to be different themes working out in different decades. The question is, are you capable enough as a retail investor to identify that? That's the challenge. So while I'll say it's going to rain, but do I know when is it going to rain? Okay, so if I don't know when is it going to rain, then I'm not going to certainly bet on it.
Yeah.
Right. So the question is, yes, the demographics are going to change. The industries are going to change. The relevance of certain industry and markets are going to be different. But the question is, can a retail investor identify that? So partly answering your question that yes, it is true that there's going to be a lot of change and shift. But the question is, as a retail investor, am I going to be able to capture that at the right time? So my suggestion to a retail investor is, as Radhika rightly mentioned, if your index is giving you a 12 to 15% or 18%, then why are we trying to do more in the expectation of generating probably 100 or 200 basis points more? So if a diversified equity fund, the fund managers anyways are looking out for trends in the market and trying to maximize that return for the investors, even in a diversified equity fund, then let that job be done by the diversified equity fund manager, right? So I think a retail investor, the less you interfere with your investments, the better you will get outcomes. So do not interfere with your investments. Let your wealth be taken care of, the wealth creation be taken care by professionals.
Okay. Radhika, quick question. SIP, lump sum investment, or both? Even sometimes I'm confused, do I go for lump sum or just do I continue with SIP? 2025, one has to strategize it. What is the right strategy for playing this?
Okay, so this is a non-popular answer. SIP or lump sum are modes, right? Now, if you're a salaried person, for instance, I can't tell my board to give me 12 months of salary in 1 month, right? So I have to do SIP. So I think of SIPs more as a savings and monthly automation tool. So SIPs continue as it is. For instance, a large part of my investments come via the SIP route because that's how I get my cash. Now, if you have money to deploy today, the question is, should you do it in a lump sum way or should you systematically stagger it using something like STP? Here is my contra answer. Honestly, if you're investing for 10 years and if you're going to do an STP and stagger that money over 6 months, nothing matters because the difference in return is 1-2%. However, for many investors, just staggering things out on worry that Trump is going to come and say something, there's a market event, etc., makes them feel good and gives them the confidence to invest. So if you're a 10-year investor, it doesn't matter. If you're a much shorter term investor and these things help you feel good, maybe it matters.
Okay. Harsh, they've told me to wrap, but a quick same question to you. Anything different on that front? SIP, lump sum, or both?
So I would just take it further from there to say that, SIP is rupee cost averaging. So if many people have the lump sum, but they go through SIP because they want to average their investments over a period of time. Lump sum is actually a power of compounding impact. So the earlier my money goes into the system, the more it is going to generate. Okay, so if I'm going to stagger my input over a period of 6 months to 2 years or to 3 years, I know people doing STPs over 3 years. So until 3 years, you're doing a rupee cost averaging. The real sense of compounding will start after your money comes into equity fund. However, having said that, each individual to their own, to their risk profile, whatever gives them sleep, peaceful sleep at night, that is the way to go about it.
Sure, peaceful sleep at night, that's the most important. Today we are not going to be, I hope everyone's partying today, but thank you so much Harshvardhan as well as Radhika for joining in with us on the show on this special day, last day of 2024. It's been a pleasure having you both on the show. 2025, your strategy should be in place because they've given you full-on insights about that. But thank you so much for tuning in, viewers. With that, we'll leave you to closing bell to take you through the action in the markets in the last 1 hour.